By tomorrow at 12 o'clock, we're putting a 50% tariff on above the tariffs that we put.
CBS's Anna Corin just visited Japan's equivalent of Detroit to see how these tariffs will impact Japan and Americans buying cars.
We have to brace for the impact. We work hard to find a way to overcome these incremental costs.
The U.S. has just cranked open a new chapter in the trade war, one with heavy burdens for Asia's auto industry. From Tokyo to Seoul, every car shipped, every component sourced, and every export plan is now facing an uncertain road ahead. For decades, Japanese and South Korean automakers saw America not just as a destination, but as a crucial partner. Together, companies like Toyota, Honda, Hyundai, Kia, Mazda, and others built more than cars. They built entire economic bridges. Many U.S. plants, many American jobs, many supply chains depend on that bridge. But trade policy is rewriting the terrain. Back when tariffs between these countries were modest, exporters operated with predictable costs. Japanese auto manufacturers paid a baseline tariff of about 2.5% on most vehicles shipped to the U.S. South Korea similarly benefited from preferential trade conditions and lower duties under various trade agreements. Then came sweeping changes. The U.S., seeking to protect its domestic auto and parts industries, threatened and in many instances imposed high tariffs, up to 25% or more, on cars and auto parts from many Asian exporters. Japan's tariff level surged, then was renegotiated down to 15% under a deal. South Korea remained under heavier tariff pressure, 25%, unless it made major investment commitments. These moves weren't just about cars, they marked a shift in Washington's strategy. More aggressive, less deferent to global supply interdependence, more focused on America first. Japan's data tells a chilling story. In August 2025, Japan's exports dipped for the fourth consecutive month. Exports to the U.S. dropped 13.8% year over year, with automobile exports plunging 28.4%. Parts and chip-making equipment also took huge hits. Where once automakers absorbed costs, cutting margins, trimming export prices, now many are passing them to buyers. Small automakers like Mazda and Mitsubishi, which have less US-based manufacturing, are feeling the squeeze especially hard. The story gets harsher. For exporters, this means recalibrating everything. Which models go to the US? Which ones stay regional? Rethinking where new plants should go, and reevaluating profits that once seemed safe. The US deal that lowered tariffs to 15% for Japanese cars gave major relief. But the damage wasn't undone. Prices were still several times what they were before the tariff surge. South Korea's situation is layered with frustration. Seoul has sought trade terms almost identical to Japan's to reduce tariff exposure, but the U.S. demands have been steep. Investment promises in the hundreds of billions in exchange for tariff relief. Hyundai has taken heavy losses. In Q2 2025, tariffs cost the company an estimated $600 to $6 million in additional duties. To mitigate, Hyundai is increasing US-based production, aiming for over 80% of its US sales to be built domestically by 2030. But this shift isn't easy, and profit margins for now have been lowered. South Korea's auto exports to the US have fallen sharply since the tariff surge began. Loss of market share, delayed demand, and rising shipping and parts cost all piling up. Simultaneously, Seoul is negotiating a trade deal. A proposed tariff cut to 15% from the existing 25%, offset by a large U.S. investment requirement, $300 to $50 billion plus. But many in Korea feel the deal isn't even. Japan got more favorable terms. While exporters in Asia struggle, American consumers are already feeling the pinch. Vehicles that once cost accessible prices are now being saddled with extra tariffs on top of rising raw material and labor costs. Dealers report fewer footfalls. Some entry-level models may vanish or be regionalized out of the U.S. altogether due to shrinking profit margins. Suppliers hang in there are steel mills, electronics, brim suppliers, plastics. All upstream parts of car manufacturing are seeing cascading hits. Delays, cost overruns, even canceled contracts. In showrooms, the instinct is retreat. U.S.-based plants are ramping up, but building new capacity takes time, permits, labor, and capital. Meantime, many U.S. buyers are pushed toward used markets. Lease extensions, delayed upgrades, fewer luxury add-ons. This isn't just about cars. It's about capital movement, investor confidence, and geopolitical posture. Japan's trade surplus with the U.S. has fallen to its lowest in years. Investors worry about recurring exposure to global regulation risk. Currency markets twitch. Firms outside the auto sector, food, agriculture, tech parts, watch warily. Asian governments are responding. Japanese officials increasingly push for stability and fairer trade instruments. Korean officials are in talks to mimic Japan's deal. But Korea argues their domestic conditions differ. Less foreign reserves, more exposure to U.S. demand swings, more risk if investment commitments don't yield returns. Credit ratings agencies warn of financial stress. Fitch notes that smaller Japanese automakers with little U.S.-based production are seeing their profit forecasts slashed. Hyundai, though larger, warns that continuing high tariffs will force more aggressive localization, but that in turn has cost. Increased labor costs, logistical complexity, and higher capital expenditure. To stay alive and relevant, automakers are innovating their way out. Japanese firms are increasing hybrid and EV R&D, attempting to push value rather than compete purely on price. South Korean giants are pledging massive investments in U.S. manufacturing capacity, seeking talent and infrastructure to reduce reliance on imported components. Both are exploring tariff mitigation via supply chain relocation, more parts production closer to U.S. plants, greater sourcing from friendly Asia rather than long foreign supply chains. Negotiations with Washington over trade deals, investment commitments, and visa or labor rules are now not just policy, but survival strategy. Consider small towns in Aichi Prefecture, Texas-sized in spirit, where dozens of Japanese auto parts suppliers supported local livelihoods. When car orders drop, those factories cut shifts, send workers home. Engineers, machinists, logistics workers, many foreign nationals, worry whether U.S. visa rules and immigration enforcement will once again disrupt their daily lives. In Seoul, boardrooms once confident now hold budget meetings. Factories are soon to be declared uneconomical for certain models. Dealers that served compact car segments struggle. Upscale models safer for big automakers, but not accessible to many. Economists warn that without swift stabilization, Asia's auto industry could shrink its U.S. footprint permanently. Losses so far run into billions for both Japanese and South Korean firms. Margins that once appeared robust are now under pressure. Bank of Korea estimates growth for 2025 will be reduced by approximately 0.45 percentage points. 2026 by approximately 0.60. Some analysts suggest we might see consolidation. Smaller automakers might exit U.S. market, partnerships may rise, and only those that can manage both scale and cost will survive. Trade policy experts also warn, every day, without clarity, consumers delay purchases, production plans get postponed, and global supply chains adjust, often toward places less exposed to U.S. policy risk. Asia's auto industry, long considered resilient, efficient, almost unbeatable, is now at a threshold. Policies meant to protect American workers have become a force pulling at the economic threads that bind nations together. Will Japanese firms stabilize under the reduced tariff? Can South Korea win a deal that's fair, not just in headline figures, but in every cost, every visa rule, every factory decision? American consumers, global investors, and communities from Tokyo ports to U.S. heartland shop floors are all watching. If Asia's automakers falter today, then tomorrow's global auto map may look very different. The real question? Who will reshape it first? Policy, protest, or profit?